Hi folks, it's James Marlay here, co-founder of Livewire Markets. Summer holidays are fading as a distant memory. The kids are back at school, and if you're looking to get yourself brushed up on what's going on in the ASX, this is the video for you. I'm joined by Rudi Filapek-Vandyck, the editor at FNArena and renowned market watcher, knowledgeable in all things ASX and markets, and we're going to be going through the moving parts on the ASX get you brushed up and ready for February. Now, Rudi, great to catch up. I love our chats ahead of reporting season. How have you been? And good to catch up.
My pleasure, James, and thanks for having me.
Now, Rudi, in preparation for today, I did have a look at some of the research that's out there. Morgan's forecast earnings growth for the ASX 200 this financial year to come in at around 8%, similar figure for FY27. That to me seems like a decent backdrop for the market, but as we know, valuations and sentiment can play a big role. Can you give me some initial thoughts on your backdrop as we go into reporting season?
Yeah. Well, at face value, those numbers are already superseded. I mean, things are going so quickly, and analysts always have to catch up with fast-moving commodity prices. So, I think the numbers now are already 10 or 11%, probably going higher. That's face value, of course. If we look back at the past, we've had 3 negative years preceding this year. So clearly, something has changed in the Australian context, and we're coming out with a big bang out of a period where only a small amount of companies were consistently and persistently growing. That difference is commodities, I mean, and the commodities market like Australia makes a big difference. In very simplistic terms, what is underneath those numbers is still an extremely polarized share market, and it has actually flipped. So the sectors that previously were almost the only ones growing in Australia and getting all the attention, they're now being relegated to being laggards, out of favor, and the sectors that previously arguably we're in a bear market, not moving and not growing and having all the headwinds too. They are now with a bang, all of a sudden in favor. They're populating the earnings forecasts. They're getting all the attention in terms of momentum, investor funds flows, etc. You can make an argument that resources and banks are now in the bull market. And you can make the argument that large other parts, the ones that previously were in the bull market, are now in a nasty, prolonged bear market. And winter has arrived for those sections. And unfortunately, for those who are hoping, with the fingers crossed, that's gonna change in February, my instinct tells me it's not gonna change in February. So February will be less about earnings than normally you would expect from reporting seasons. It's also good to explain also, it's not that the growth stocks, the quality stocks, the AI stocks, it's not that they now have negative earnings growth. They don't. But it's just that the forecasts that underpin their growth, they're now in a negative trend basically, and they're impacted by higher bond yields, by a stronger currency, and in some cases by some specific industry-related matters. So they're still growing, but there's more growth to be had elsewhere, and investors have made that switch. I mean, at FNArena, as you probably know, we on a daily basis we're updating those forecasts, and in particular, smaller mining companies. We are sometimes changing numbers by 100%, right? And that obviously explains also why the share price rallies can be so strong in those segments of the market, but it's still very polarized, and I don't think that's going to change anytime soon. Maybe one element to throw in here to show how much polarized this share market is. Out of all the stockbrokers that we cover, 2 out of 3 ratings currently in place are buy ratings at the moment. Now, stockbrokers have the reputation of always issuing more buy ratings, but we have historical numbers, and then they're normally never this high. And this just signifies that there's buy ratings on one end because there's more good news coming, and there's buy ratings on the other end where share prices continue to fall, and brokers can't believe how low those share prices go.
On that broker research, it's something that you do a lot of at FNArena, is looking at the research that's coming out of the investment banks and the broking houses. Any particular themes or ideas that have caught your attention?
Let's start with the banks. So there is a positive sentiment coming through on the basis of interest rates going higher, and the economy at face value looks in very good shape. So everyone who was convinced that there's no life in banks because they are too expensive, that might yet again be proven wrong this year. Question marks around CBA, yes, but they will have to prove in February that they deserve their premium rating. There's clearly a lot of now euphoria coming in the resources space. I mean, the prices are going up for just about anything. Resources is less about your typical earnings. I mean, I remember many years ago, MIM, Mount Isa Mining, very questionable reputation. They would issue profit warnings, and the share price goes down, and then 3 days later, the share price is back up where it was because commodity prices were going up. And that's sort of what shows you also the dynamic in reporting season. It matters a lot less about, unless really they come out with like some really bad results. In the slipstream of resources, very important, I think, the contractors, the engineers, they're obviously having a really good time. You can argue that that's priced in, but that's on the assumption that there's no new contracts coming through, and that's probably the case. I mean, I saw NRW Holdings announcing even more contracts. I mean, so you basically own those stocks because the bull market is extending. You have, of course, the other end, the REITs, the growth stocks, the quality stocks. They're all suffering at the moment. Higher RBA rates, stronger currency. A lot of our quality companies are active in the US. It weighs on them. And then there's a big question mark. Retailers, consumer stocks. RBA has just raised interest rates. We might see another one. At the very least, Morgan Stanley has issued a warning, and they say to investors, be prepared for much more benign conditions in the second half of the year. While the RBA raised rates on the basis of the economy is stronger than expected. I noticed that last year, retailers were issuing profit warnings. So there is that K-shaped economy. It's not a straight line. Personally, I'm a little bit more cautious on consumer spending. My observations about the economy do not align with the official statistics and data. So I know all of companies ultimately do come back to consumer spending, but when it comes to direct consumer spending stocks, I've gone for the defensive. I'm in Chemist Warehouse, Sigma Healthcare, and I think it's a less risky trajectory, I think, of playing that theme.
I don't think we can ignore what's going on in the growth and the technology part of the market, which is, on the day we're talking, being put under the blowtorch, I think would be a nice way of saying it. What's your take on what's happening there? And maybe talk us through your thoughts there.
Winter has arrived. I think that's the easiest. I mean, some people out there they talk in terms of bear markets when share prices are down by 20% or something like that. I think that's a very simplistic way of looking at it. I mean, to go to the core, when there's a bull market, investors are looking for reasons to buy. If it's a bear market, investors are looking for reasons to sell. And well, once upon a time, those concepts would apply to markets as a whole. Think about the GFC, think about the Nasdaq meltdown 2000. Increasingly in later times, those two concepts, they're basically rolling through the market and gripping the sections of the market, each separately from each other. We've had resources in a bear market for 2 or 3 years previously. We had a runaway bull market for anything that was related to technology, to AI. Quality stocks have outperformed for 15 years. That has now flipped. So we're now looking to sell anything that is above average PE ratio. You have to think quality growth, technology, anything related to data centers, AI. It's all out of favor. And on the other end, of course, anything that smells about gold, silver, lithium, uranium,
Copper.
it's all flying away. One of the things that I come across as well, that is something to consider as well, is that people often don't realize, but the markets behind those companies are really, really small, and in some occasions really, really tiny. So while a lot of people have been focusing on the effect of ETFs on equities in over the past decade or so, we are now maybe seeing the effect of equities on commodities. And if the money is really coming in very, very hard as is, you have to question how much those markets can absorb. Right? And you saw recently what happened with gold and silver. That might simply be an effect of too much money coming in. I believe the narratives are there, but the volatility is there too. And I think that's one of the reasons why you will see more volatility in these markets.
Now, Rudi, we've touched on resources, we've touched on technology. They're two parts of the market that are in the headlines for different reasons at the moment. What's being overlooked? Are there opportunities in sectors that have been pushed to the side? Last year, healthcare was a difficult part of the market. Are there any opportunities in overlooked sectors?
Healthcare is still a very difficult sector. I think what we've left behind is that we were treating healthcare as the go-to sector that couldn't lose. Right? The heydays of ResMed, CSL, Cochlear, and the likes, they're definitely behind us, and we're now talking very subdued forecasts. I see analysts still very cautious about Helios, Sonic Healthcare, about Ramsey Healthcare, pathology in general, and that by default makes me almost cautious. The big discussion about CSL is whether, if they simply meet expectations this season, but that's going to be enough. And there's other people who obviously think that's not going to be enough. So that debate goes on. The one thing that I find personally very disappointing is I'm obviously a shareholder in ResMed. I think ResMed is now the number one company in that sector. They came out in January with a fantastic result, beating expectations, forcing analysts, even with a stronger Aussie dollar, to increase their forecasts. And guess what? Apart from on the day of release, the share price is only going down, and that in itself, I think, is to me, very indicative of what the situation will be in February. Which leads me to one conclusion, is that February will be less about actual results and more about momentum, investor sentiment, and the likes. And unfortunately, there's nothing the companies can do about it. I mean, Xero gave a presentation to analysts. They pulled forward the point of reaching break even for their Melio acquisition in the US by 3 years. In any different market, that would have pumped up the share price by 10-15%. We are seeing the opposite. I mean, again, except for on the day of release, there's no appetite. If I can just make a comparison with the US, Microsoft got sold off by double digits. Their numbers missed consensus by 1%, and the key reason why they missed by 1% is they had to reallocate some of their hardware, basically, and they gave it to themselves to develop Copilot instead of giving it to their customers. But again, the market simply has no appetite for any detail. If you're in the wrong sector now, and then you're gonna be sold down. Having said so, there's always room for more positivism in February, and there are a few companies that when I go through the analysis report, there are a few companies that are being highlighted as potentially giving the positive surprise, and one that's often mentioned now is Flight Centre, and a cheaper currency should all else being equal, should help them as well. One that's often mentioned, and it's quite a small one, and it hasn't been listed for that long, but there's a lot of people are positive about GemLife. Company code, I think, is GLF. Other companies that are mentioned are Superloop and Aussie Broadband. And you have Temple Webster that is often being mentioned, but I think the problem there is you can still throw the technology label over it, and that will be for many companies a disadvantage in February, I think. Given we have this really strong flip between value and growth, it is well possible that a lot of people will now start looking at the laggards from and whether they can make a comeback in February. That is possible, but I still can't get enthusiastic about the likes of Horizon Holdings or Lend-Lease or Bapcor. And like I mentioned earlier, and Helios, I still would be refrain from expecting too much from those companies. But hey, we all have our own strategies, and on a larger scale, I think Macquarie is making a comeback, and that's probably deservedly so. We are in the background. We are seeing a lot of IPOs. We're going to see a lot of capital raisings and all of that. People always look at Computershare, but I think Macquarie is the key beneficiary there, and they are using technology to take market share away in Australia. So they're doing quite a good job at it. A stock that has my personal attention is Goodman Group. I think Goodman Group will be very important for the AI trade in Australia. Amongst all the narratives that were going around last year, one of them was you can never make money out of data centers, which obviously is ludicrous. But hey, you can't argue with the crowd. And the share price is now a lot lower than where it was last year. Having said so, I hope to come out with a good result, of course. But I'm not so sure because of the corner where it is, because of sentiment at the moment where it is. As I said earlier, I'm not sure whether earnings are going to change much in sentiment. I think there's nothing much the companies can do about it. It'll have to come from elsewhere. And maybe, as another example, in January, Korea sold off by 40%. Not because the results were bad, no, because the management stuck to their guidance, and it was based on a weaker Aussie than where it is now. What has happened since is that they're now going to merge with a US company, and then of course that signifies to me that what used to be the growth technology, the higher PE stocks, they've now become value plays, and we all know that's what the bear market does. We know instinctively that the bear market creates opportunities when it ends. We just don't know when that will happen and how low share prices can go in the meantime.
Rudi, you've mentioned a bunch of names there. I was just thinking, as we look at reporting season, are there a couple of results from stocks that you think might be bellwether indicators for industries across the market that you think are going to be particularly interesting to watch?
Well, I've mentioned Goodman Group, and I think Goodman Group is for the AI trade. I think for consumer spending and that section, I think that people will be watching the likes of Wesfarmers. Coming back to the laggards that I've mentioned earlier, on the macro level, we obviously have a company like Woolworths, for example. I think a lot similar to CSL. I think people are going to be looking for Woolworths and thinking like, are they finally ready to not disappoint? And maybe that gap with Coles can narrow. Exactly. So there is that same CSL theme is there because it has been a while. That would normally also apply to Macquarie. Macquarie has 2 or 3 years of basically standstill, but I personally think that they're probably ready to turn that around. The big thing in the amongst the banks, of course, is CBA. I mean, they will have to prove that they still deserve to trade on the premium rating. And so far, I mean, the evidence is that they are still on a premium, and they've kept it. Although that has narrowed as well. Maybe the premium got a bit too large last year.
One part of the market we haven't discussed specifically is the old classifieds businesses, REA groups, CAR group, stocks that investors have said these are the ones you want to pick up on a dip because they're always expensive. We've got a dip right now. What's your take on what's happening in those platform businesses?
I would normally have mentioned them as well, but unfortunately, they're part of that of the baskets that I mentioned earlier. I mean, I'm shareholder in CAR Group. I'm shareholder in REA. I on a regular basis see emails entering my inbox where people are picking apart all the negative scenarios for REA and addressing them in a positive way. In very simplistic terms, we're now afraid that that AI is going to destroy those platform businesses. For REA specifically, there was a threat of increased competition or irrational competition. Again, I would normally nominate them as results to pay attention to, on the basis of the experience and observations and the trends that leading into reporting season. I'm actually not so sure whether either of those companies can change the trend. I think at the moment the hurdles sentiment is too negative, and that means as an investor you either have to abide and wait for better times to arrive, or you step aside and you just wait for things to come.
Now, Rudi, a couple of questions to finish up. Over the years, I've asked you about cash holdings. I think at one point it was as high as 20%. Maybe give me a sense of how much cash you're holding at the moment. Is that higher or lower than average?
Yeah, Harry Hindsight tells me every morning that I've not done the right thing, but we know that Harry Hindsight is really wise. So I've had 10% now for a while. I think it was a little bit higher at some point last year, and I used it to buy Sigma Healthcare. I also bought Washington Saul Patterson. I also bought ProMedicus, by the way, and 2 out of 3 ain't that bad. 10%, I haven't used it for 2 reasons. One is that I thought, and probably rightfully so, that we will see a lot of volatility leading into February, and you want to have some cash ready anyway, because otherwise you can't jump on opportunities. But I also believe that February itself will probably again be exceptionally volatile. And if we look at the trend from just the last 2 reporting seasons, I mean, last year, February, I still vividly remember that February was above average volatile. And at that point in time, it was the most volatile reporting season we had seen in quite a while. And then August came along, and August was the next step up, was even more volatile. I think just simply looking at what happened late last year and already in January, where, for example, also a generation development just I mean, share price tanks on what arguably are quite small misses. I think we should be prepared to see a lot of volatility kicking in February. And one of the reasons, one of the ways of how you can anticipate that, how you can play that, is by having cash available, of course. So I'm more than happy to have stuck to my 10%. And of course, as Harry reminds me every morning, it's not enough. But hey, I only have 10% at this point in time.
Rudi, you've mentioned a few times you've used the bear market word a few times. You've mentioned it, sprinkled it through our chat. The winter is coming. That's just for part of the market, or more broadly?
People, as I said, traditionally they look at the market as a whole, but the index already has, for the last 15 years, if not 20 years, the index that we see, that's no longer representative of what happens underneath it. And I think we investors, I'm simply on the basis of observations. Everything that is quality growth, anything that's growth, everything that's technology, everything that's AI related and data centers, they have all been in the bear market since approximately July last year. On the basis of my experience from late 2016, I was expecting that might come to an end in January, and it hasn't. And I think we should now be prepared to have a bear market that goes on for longer for those segments of the market. And in the meantime, for some investors, it won't matter because they're not there in the first place, and they happily scooping up more gold stocks.
Well, Rudi, I really appreciate you giving us your time today. I always enjoy our pre-reporting season discussions. Good luck. I know you're going to be really busy over the next month, and we look forward to your analysis on the other side of reporting season.
My pleasure, James, and thanks for having me.
It's been a pleasure. Ladies and gentlemen, I hope you enjoyed that chat with Rudi Filapek-Vandyck, the editor at FNArena. We're going to have tons of reporting season coverage on Livewire and Market Index this February, so make sure you check it out, and we'll be dropping more videos just like this regularly on our YouTube channel.